School of Management Studies IGNOU presents an audiobook on the course MMPC 004 Accounting for Managers for MBA program. Presenting Block 1 Accounting and Overview, Unit-4 Preparation of Final Accounts of Companies.
After completing this unit, you should be able to discuss the applicability of various provisions in the preparation of the financial statement, understand the structure and preparation of profit and loss statement of a company, understand the presentation and disclosure of company's balance sheet, understand the structure and preparation of cash flow statement. Introduction. Companies are required to prepare their final accounts as per the provisions of the Companies Act 2013. They should prepare and keep the books of accounts of every financial year at their registered office, which gives a true and fair view of the state of affairs of a company. Companies should keep the books of accounts on an accrual basis and according to the double entry system of accounting. As per Section 129 of the Act, at the time of the company's annual general meeting, it is mandatory for the board of directors to lay down the financial statements before the company. The financial statements include: number 1, profit and loss statement; number 2, balance sheet; number 3, cash flow statement; number 4, statement of changes in equity; and number 5, notes to accounts. Here you should note one thing, that cash flow statement is not a part of financial statements in case of one-person company. Final accounts must give a true and fair view of a company at the end of the financial year. Further, special acts are applicable for insurance, banking, electricity supply, or any other class of companies to prepare the financial statements, while in case of all other companies, balance sheet and profit and loss statement is prepared as per Part 1 and Part 2 of Schedule 3. It is mandatory for the companies to comply with the accounting standards as notified by the central government from time to time. Schedule 3 of Companies Act 2013. The companies must prepare and present their final accounts as per the Schedule 3 of the Company Act 2013. The schedule was formulated in order to keep pace with changing economic philosophies leading to privatization, globalization, and subsequent desired changes in corporate financial reporting practices. The several new features of Schedule 3 are: number 1, vertical format of presenting the balance sheet items and their classification into current and non-current heads. Number 2, vertical format of profit and loss statement with classification of expenses based on nature. Number 3, elimination of the concept of schedules, and such information is now furnished in notes to accounts. Number 4, it does not contain any specific disclosure for items included in Schedule 6 under the head Miscellaneous Expenditure. Number 5, debit balance of profit and loss statement will be disclosed as a negative figure under reserves and surplus head. Number 6, preparation of cash flow statement as per Accounting Standard 3 or AS 3. And number 7, the schedule gives prominence to AS in case of any conflict between AS and schedule. General instructions for the preparation of financial statements. Number 1. Schedule 3 provides minimum requirements for disclosure on the face of the balance sheet and the statement of profit and loss, herein after referred to as financial statements and notes. Number 2. This implies that new line items or sub-items can be added or substituted in the financial statements when such presentation is relevant to an understanding of the company's financial position or to meet industry or sector-specific disclosure requirements, or when required for compliance when statutory changes are made, especially in case of the amendments to the Companies Act or under the accounting standards. Number 3. Where compliance with the requirements of the Act, including accounting standards as applicable to the companies, require any change in treatment or disclosure, including addition, amendment, substitution or deletion in the head or subhead of any changes, interest in the financial statements or statements forming part thereof, the same shall be made and the requirements of this schedule shall stand modified accordingly. Number 4. The disclosure requirements specified in this schedule are in addition to and not in substitution of the disclosure requirements specified in the accounting standards prescribed under the Companies Act 2013. Additional disclosures specified in the accounting standards shall be made in the notes to accounts or by way of additional statements unless required to be disclosed on the face of the financial statements. Similarly, all other disclosures as required by the Companies Act shall be made in the notes to accounts in addition to the requirements set out in this schedule. Number 5. Notes to accounts shall contain information in addition to that presented in the financial statements and shall provide, where required, narrative descriptions or disaggregation of items recognized in those statements and information about items that do not qualify for recognition in those statements. Number 6. Each item on the face of the balance sheet and statement of profit and loss shall be cross-referenced to any related information in the notes to accounts. In preparing the financial statements, including the notes to accounts, a balance shall be maintained between providing excessive detail that may not assist users of financial statements and not providing necessary information as a result of too much aggregation. Number 7. Depending upon the turnover of the company, the figures appearing in the financial statement may be rounded off. Number 8. Once a unit of measurement is used, it shall be used uniformly in the financial statements. Number 9. Except in the case of the first financial statements laid before the company after its incorporation, the corresponding amounts, comparatives for the immediately preceding reporting period for all the items shown in the financial statements, including notes, shall also be given. Number 10. For this schedule, the terms used herein shall be as per the applicable accounting standards. Balance Sheet Part 1 of Schedule 3. Assets are those resources controlled by the enterprise due to past events from which future economic benefits are expected to flow to the enterprise. Liabilities are the obligations of an enterprise arising from the past events, the settlement of which leads to an outflow of resources embodying economic benefits. And equity is the residual interest in the interest of an enterprise after deducting all the liabilities. Now let's try to understand some of the items that are explained in the notes to accounts. Share capital. For each class of share capital, certain points should be kept in mind. They are: Number 1. The number and amount of shares authorized. Number 2. The number of shares which are issued, subscribed and fully paid and which are issued, subscribed but not fully paid. Number 3. The par value per share. Number 4. Shares outstanding at the beginning and at the end of the reporting period should be reconciled. Number 5. Calls unpaid. And number 6. Forfeited shares. Reserves and surplus. Reserves and surplus can be distributed among these certain subheads. They are: number 1. Capital reserves. Number 2. Capital redemption reserves. Number 3. Securities premium. Number 4. Debenture redemption reserve. Number 5. Revaluation reserve. Number 6. Surplus, the balance as per profit and loss statement. And number 7. Other reserves, specifying the nature and purpose of reserves. Long-term borrowings. Long-term borrowings can be classified as: number 1. Bonds and debentures. Number 2. Term loans. Number 3. Deferred payment liabilities. Number 4. Deposits. Number 5. Long-term maturities of finance lease obligations. Number 6. Loans and advances from related parties. And number 7. Other loans and advances. Long-term provisions. These can be classified as: number 1. Employee benefits provision like gratuity, provident fund, etc. And number 2. Other provisions. Short-term borrowings. Short-term borrowings can be classified as: number 1. Loans repayable on demand. Number 2. Loans and advances from related parties. Number 3. Deposits. And number 4. Other loans and advances. Other current liabilities. Some of the other current liabilities can be grouped as: number 1. Interest accrued but not and due on borrowings. Number 2. Income received in advance. Number 3. Unpaid dividends. Number 4. Application money received for allotment of securities and due for refund and interest accrued thereon. And number 5. Other current liabilities. Tangible assets. Tangible assets can be classified as: number 1. Land. Number 2. Buildings. Number 3. Plant and equipment. Number 4. Furniture and fixtures. Number 5. Vehicles. Number 6. Office equipment. And number 7. Others. A detailed report showing additions, disposals, acquisitions through business combinations and other adjustments and amount related to depreciation, impairment losses, revaluation, etc. should be provided for each class of asset. Intangible assets. Intangible assets can be classified as: number 1. Goodwill. Number 2. Brands or trademarks. Number 3. Computer software. Number 4. Mining rights. Number 5. Publishing titles. Number 6. Copyrights, patents and other intellectual property rights, services and operating rights. Number 7. License and franchise. Number 8. Recipes, models, designs, formulas and prototypes. And number 9. Others. A detailed report showing additions, disposals, acquisitions through business combinations and other adjustments and amounts related to depreciation, impairment losses, revaluation, etc. should be provided for each class of asset. Non-current investments. Investments can be classified as: number 1. Investments in property. Number 2. Investments in equity instruments. Number 3. Investments in preference shares. Number 4. Investments in governments or trust securities. Number 5. Investments in debentures or bonds. Number 6. Investments in mutual funds. Number 7. Investments in partnership firms. And number 8. Other non-current investments. Long-term loans and advances. It can be classified as: number 1. Capital advances. Number 2. security deposits. Number 3, loans and advances to related parties. And number 4, other loans and advances. All these loans and advances can be further classified as secured considered goods, unsecured considered goods, and doubtful. Current investments. It can be classified as number 1, investments in equity instruments, number 2, investments in preference shares, number 3, investments in government or trust securities, number 4, investments in bonds or debentures, number 5, investments in mutual funds, number 6, investments in partnership firms, number 7, other investments. Inventories. Inventories can be classified as number 1, raw materials, number 2, work in progress, number 3, stores and spares, number 4, finished goods, number 5, loose tools, number 6, stock in trade, number 7, goods in transit, and number 8, others. Cash and cash equivalents. They can be classified as number 1, balances with banks, number 2, checks, drafts in hand, number 3, cash in hand, and number 4, others. Cash flow statement. The cash flow statement is prepared in accordance with the provisions of Accounting Standard 3. It provides information about the cash flow position of an enterprise. Further, the statement also identifies the cash from operating, investing, and financing activities. The purpose of the statement is to explain the cash movement between 2 points of time. The sources of cash include the issue of shares, debentures, raising of long-term loans, sale of an investment, sale of fixed assets, and cash from operations. In contrast, application of cash includes redemption of shares, debentures, repayment of a long-term loan, purchase of fixed assets or investment, payment of tax, dividend, and net operating loss. You should note one thing here, that cash includes cash in hand, demand deposits with bank, short-term liquid investment, and securities with short-term maturity, that is, less than 3 months from the date of acquisition. The cash flow statement includes 3 major elements, namely, number 1, cash flow from operating activities. These are the principal revenue generating activities of an enterprise. Positive cash flow from operating activities helps an enterprise maintain its operating capability, pay dividends, repay loans, make new investments, etc. It also provides valuable information about financing through working capital. Number 2, cash flow from investing activities. It deals with the acquisition and disposal of long-term assets and other investments. In other words, it represents the extent to which expenditures have been made for resources intended to generate future income and cash flows. And number 3, cash flow from financing activities. These are the activities that result in changes in the size and composition of owners and borrowed capital. These are useful in predicting claims on future cash flows by providers of capital to the entity. Examples include cash proceeds from the issue of equity shares, loans, debentures, etc. Statement of change in equity. Number 1. It is the reconciliation between the opening and closing balance of shareholders' equity. Number 2. The statement summarizes the transactions related to the shareholders' equity over an accounting period. Number 3. It records movement in retained earnings, other reserves, and changes in share capital. Number 4. Statement of changes in equity is to be presented and it includes certain components. They are: Number 1. Reconciliation of the opening and closing balances of equity describing changes in detail. Number 2. Details of comprehensive income for the accounting period. Number 3. Details of changes and the impact when components of equity are restated. Number 4. Applied retrospectively in accordance with the IAS and IND AS 8. And number 5. Comprehensive income is the incomes listed after the net income on the income statement.
We were listening to the audiobook by the School of Management Studies IGNOU for MBA program course code MMPC 004 Accounting for Managers. Course Coordinator Professor Kamal Vagrecha, School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Uday Sharma. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.